Everybody take their seats. We have our leadoff speaker here, so we can get started. Today we have our third and final panel, CEF panel, and we've selected a handful of people that have raised concerns or issues that we've heard from. We've got the NFA, who's going to have a big role in surveilling the CEFs here today, and we have all manner of different representations of either CEFs or market providers. We're going to start off the day with David Van Wagner, who I think you all know, and who the chairman delivered his email to the entire world and said, if you have a problem, call David. This is who you call. But David's going to give us a quick overview of the rule and the issues that they're dealing with and the path forward. Obviously, as I noted earlier, we're 20 days away. We've got a number of CEFs to do. I think he's going to touch on made available for trade determination. And then I'd like to recognize after that Nicholas to give a brief EU perspective on trading. I think we've had some significant challenges in terms of the international front with the October 2nd deadline and what that means for the previous agreed upon proposal between Barnier and Gensler. And then we'll go start with Scott, and we'll I think we're going to go with Jane next with NFA to kind of give a perspective on over that, and then we'll get into the market participant issues from there. So David Van Wagner, please kick us off.
Thanks very much, Commissioner O'Malley. I'm not quite sure our other commissioners listening in, but greetings to the chairman, Commissioners Chilton and Weegan as well, and the members of the Technology Advisory Committee. Yeah, I was just going to give a quick overview of the CEF rulemaking, a little bit of context of where it sprung from in the CEA, the made available for trading or MAT rulemaking, and I'm going to quickly segue into using acronyms entirely, so hopefully people are up to speed on those. And basically our progress in reviewing CEF applications and some upcoming key dates. The CEF rulemaking, of course, comes out of the CEA. Section 5H basically sets forth basic registration and compliance requirements for CEFs, including 15 core principles that all CEFs have to comply with to attain and maintain registration. And of course, the goal of one of the overarching goals of the section is to promote the trading of swaps on CEFs and to promote pre-trade transparency in the swaps market. Part 1A50 of the Act defines CEFs, and it's a fairly broad definition, basically a trading system or platform in which multiple participants have the ability to execute or trade swaps by accepting bids and offers made by other multiple participants through any means of interstate commerce. Also, Section 2H8 is key here. It basically establishes what we call the trade execution mandate, whereby swaps that are subject to the clearing mandate and have been made available for trading on a CEF or a contract market, a DCM, become subject to that mandate and have to be traded from that point forward on a DCM or a CEF. So our CEF rules set forth they have a fairly broad registration requirement, which essentially states that any person who operates a facility that meets the CEF definition, that is a many-to-many platform, has to register as a CEF. To be clear here, that registration requirement is not tied to the trading of swaps that are subject to the trade execution mandate. I've got a little notation here. It's a number 88, which corresponds with a footnote in our rulemaking, which makes this, I think, pretty clear, along with 37.3. And basically, also in our preamble, we give some examples of markets which would trigger, in our view, which would trigger this registration requirement, and probably more importantly, some of the the platforms which wouldn't trigger the trade registration, excuse me, the CEF registration requirement. Essentially, we really set forth only two examples, and they are a pure dealer market, where a dealer sets up a market, posts bids and offers, and stands ready to be the buyer to every seller and the seller to every buyer. And also, of course, continued private negotiation between two parties who contact each other in whatever way they might, but they basically privately negotiate and consummate the transaction between the two. But that's a pretty small sliver of the universe, we think, of where swaps are executed now. Upon registration, CEFs have to comply with all the core principles and the related rules, and they also have to emphasize one point, they also have to meet what we call the minimum trading functionality. Essentially, they have to have an order book, and that being a trading system in which all market participants have the ability to enter multiple bids and offers, observe or receive bids and offers entered by others, and to transact against those bids and offers. That is it's a minimum functionality. It is not one that has to be followed for all trading on the first days of CEF registration, because there's not likely to be a trade execution mandate. We actually divide transactions into CEFs into sort of two classes, basically required and permitted transactions, which correspond with those swaps that are subject to the trade execution mandate, i.e. required transactions, and those that are not subject to the trade execution mandate, and those are permitted transactions. When it comes to permitted swaps with permitted transactions, really anything, any trading methodology that the CEF wants to establish can be used. However, when a swap becomes subject to the trade execution mandate, essentially its transactions in those swaps are considered to be required transactions. And required transactions really can only be executed in two ways. Well, three ways, because block transactions are still permissible. But essentially you have to, the trading is limited to either an order book, as described earlier, or an order book plus an RFQ functionality. We basically, in our rulemaking, we established that the RFQs have to go out to a minimum of 3 market participants. There's a phase-in period for that requirement. 1 year from the compliant, up until 1 year from the compliance date, the minimum can be RFQs to 2. When responses come back from market participants who've been issued RFQs, the CEF is expected to basically convey that information along with anything that's outstanding in the order book, which has to exist side by side with any RFQ mechanism, and that's conveyed to the market participant who asked for the quotes. So far, we've been handling, registration applications from CEFs. Most of them have availed themselves of our temporary registration avenue. That is, you submit your application and ask for temporary registration. We will review the application essentially for completeness. We do not do any sort of drill down on substance. We make sure that you are answering the questions in an appropriately responsive manner, but we are not drilling down with any depth on substance. That will be done after temporary registration is granted, and when we are able to conduct a full review of all the applications. So, but upon a grant of temporary registration, the CEF itself, when it begins operations as a CEF, is expected to comply with all the requirements applicable to CEFs. And just just to make sure that that message is clear, and you're at risk. So, for instance, if there are problematic things in your application, which we might not have caught because we only really did a complete application review, you're potentially at risk if you try to get away with something. I mean, hopefully, most of these things are questions of some judgment issues, and we'll work through it with CEFs. But if people try to do something blatant, we, I think, always have it within our discretion to ring our friends in enforcement and let them know about things like that. So just to let you know, it's not you don't get a free pass with temporary registration. You're expected to comply with everything that's applicable to CEFs. So far, we've got 17 CEF applicants, which corresponds with the number that we thought we'd see. All of them are asking for temporary registration. To date, 3 of them have been granted temporary registrations. Most and we expect that we're going to be able to roll forward with most of the remaining applications by October 2nd. Most of the prospective CEFs are already extant swaps trading platforms. So prior to Dodd-Frank, they were essentially relying on a number of exclusions and exemptions from in the CEA as a result of the CFMA in 2000. Those operations are continuing to rely upon those exemptions and exclusions pursuant to a DMO no action letter that we issued in June. 1328, but that no action letter essentially comes to an abrupt stop on October 2nd, which is also fortuitously the compliance date for the CEF rulemaking. So obviously orchestrated to transition entities to the CEF rules. So that's really about it on the CEF rulemaking. And some of the aftermath. Just a few words about the made available for trading rulemaking, which was done on the same day as the CEF rulemaking. Essentially, again, this is the trigger for the trade execution mandate. Under the CEA, a swap that is subject to the clearing mandate must be traded on a DCM or a CEF unless no DCM or CEF makes it available. So the mechanism we set up to determine whether something has been made available is, or the MAT determination we'll call it, is that the DCMs or CEFs would make a filing with us under our Part 40 rules, which are basically the rule filing procedures, and they would make their case that they are listing a swap that's been made available for trading. Basically, kind of 2 fundamental prerequisites for making the filing the swap in question has to be subject to the clearing mandate. You can't do it in advance of the clearing mandate being subject to the swap being subject to the clearing mandate, and also the DCM or the CEF, because the DCMs could make this filing as well. The DCM or CEF actually has to have listed this swap, and we've set out a number of factors that the DCM or CEF should address when they make that filing, and they'll be considered by the Commission. You can make this filing either as a self-certified filing, a rule filing, or you could affirmatively ask for Commission approval. In the MAT rulemaking, the Commission essentially committed that at least in the early days of MAT determinations, it would take the full amount of time that's going to be available to it under the Part 40 rule processing procedures, which essentially means it's approximately a 90-day review period, whether you go either route. We also made a commitment that we would publish the filing itself and ask for comment via our website. And then upon either the Commission approving a self-certified filing, the filing, or the self-certification, period passes and the Commission doesn't object, that's the trigger for the trade execution requirement. Actually, 30 days after that event, is when the trade execution mandate would apply. And of course, the knock-on effect would be that particular swap has to be traded on a DCM or a CEF, on the DCM or a CEF. And when it is traded on, at least on the CEF, it can be only traded according to those functionalities I described earlier, the order book or the order book plus the RFQ. So I guess the last point to quickly make is that most CEFs have indicated that even the ones that have already gotten temporarily registered have said that they're going to be pushing off their start date till approximately October 2nd, no later than that. And so even assuming immediate made available for trading filings by a CEF on October 2nd, it is, if you do the math, the earliest trade execution, the earliest date that a trade execution mandate could kick in would be on or about February 1, 2014. So that basically concludes my remarks. Thanks very much.
Thank you, David. Nicholas, can we ask you to provide a brief summary of the international or the EU perspective?
Thank you. The European Union is engaged in the implementation of the G20 commitments on the trading of OTC derivative contracts. The trading obligation is a major component of MiFID II negotiation in Europe. MiFID II includes an obligation to trade OTC derivatives on trading venues. It introduces a new category of trading venues, the so-called OTF, Organized Trading Facilities, and it defines a stringent transparency regime for swaps. In terms of objectives, the EU and US regimes are very much aligned. I'd like to underline that on certain aspects, in a number of areas, MiFID regime is even stricter than CFTC requirements. First of all, regarding the trading obligation determination, a difference is that in Europe, the decision will not be made by the exchanges, but the decision will be made by ESMA and the European Commission, who will decide when a contract is subject to central clearing, whether it is appropriate for mandatory trading. In the field of pre-trade transparency, we contemplate a higher degree of multilaterality for the trading platforms that will be used to comply with the trading obligation. On voice trading as well, we think that we will leave less room to voice trading in Europe. And we also have significant differences between the OTF regime and the CEF regime. In particular, in Europe, an OTF will not be allowed to match clients' trade against its own book. Whereas I understand that it's possible in the US, although it's true that there will be safeguards when it's done in terms of timing for execution and of governance of the CEF. There are other issues we will look carefully in the US regime, such as the block trade exemption, because we wouldn't like that by introducing a similar approach, we would open significant loopholes. So despite these differences, I think I can safely say that the objectives are there, and we are pretty much aligned. This is the reason why in July we have recognized these similarities in the path forward agreed between the European Commission and the CFTC, and we have recognized the need for an internationally consistent implementation of these regimes. To quote the path forward, we wrote that regulatory relief to trading platforms that are subject to requirements that achieve regulatory outcomes that are comparable to those achieved by the requirements for CEFs should be considered by January 2014. To us, this aspect, this commitment to consider a specific regime for non-USF is a very important aspect of the path forward concluded in July. We think that the registration requirement is not in line with the objectives of this path forward, and could potentially raise significant issues. First of all, practical issues, because it might be very difficult for non-US CEF and European CEF to register by the 2nd of October, and if they were not able of doing so, it could have market implications. And more fundamentally, we think that a model of dual registration and dual supervision of CEFs is not the optimal model to have global integrated markets. We think that a dual regime of supervision of CEF could cause serious and durable market fragmentation, because it would imply that a trading venue active in the EU and the US would need to accept duplicative regulatory requirements and dual supervision with potentially conflicting rules. As a result, the market would probably fragment. Participants would seek only to interact with non-US persons to avoid the duplicative or conflicting requirements. And moreover, some trading venues could decide to split markets between a CEF pool and a non-CEF pool. Split pools would mean unequal competition between EU and US venues and users. Moreover, split pools would significantly undermine the efficiency and functioning of international markets. And at a time when growth may be returning and the need for international capital flows will become more acute, this could affect end investors and ultimately the real economy. So this is the reason why we think that we should really pursue the discussion on this topic and engage further in the definition of this non-US CEF regime. And I would like to note, to conclude, that this is also in line with the recent call on regulators of the G20 leaders in St. Petersburg, who said that regulators should defer to each other's rules when it is justified by the quality of the respective regulatory and enforcement regimes, and that they should settle the remaining issues relating to overlapping cross-border regulatory regimes and regulatory arbitrage. Thank you.
Thank you, Nicholas. We're going to go to Jane from NFA to report on kind of the integration, so to speak, the surveillance responsibilities. I think just about everybody has signed up that has applied to be a CEF has signed up with the NFA to conduct their surveillance. Maybe a few that have not, but by and large, most people are going through NFA. So NFA's participation here is pretty relevant.
Okay, great. So thank you, Commissioner O'Malley, for the opportunity to present here today. To date, NFA has signed regulatory services agreements with 15 applicants as permitted by Commission Regulation 37204 that allows the CEF to contract with a Registered Futures Association to assist in complying with the CEF core principles. All 15 of those, as of this week, now have applications before the Commission for temporary registration. 3 of those have been granted temporary registration, as David mentioned, and 2 of those CEF applicants also intend to operate DCMs for the transacting of swaps. So today, I want to give to you an overview of the technology and specific data element requirements necessary for NFA to conduct regulatory services for those CEFs under contract. As most of you know, NFA currently utilizes electronic systems to conduct surveillance for both DCMs, trading futures contracts, and retail OTC currency trading facilities, the RFEDs, since February of 2011. So we have used these existing systems and the CFTC's proposed and now final CEF and DCM regulations as our guide in developing a new surveillance system for swaps. Additionally, prior to my joining NFA, the NFA Market Regulation Group spent several months in New York and New Jersey visiting some of the larger potential CEFs in order to learn just how these swaps markets operated. From those meetings, NFA Market Reg and our IT department developed an 80-page data specification that all potential CEF applicants need to map to in order for NFA to conduct surveillance. The commission was consulted and offered several good suggestions that we incorporated into that. So, let's see. Regulation 37203 requires a CEF to have an automated trade surveillance system. That's actually the service that we're providing to the CEFs under contract. It also provides 24 hours to load and process those transactions. So what we're doing is we're getting nightly files from the different CEFs, and those, we're actually getting 21 files that can be categorized in 4 general categories. So the first one, exchange activity. This is actually what happened in the markets yesterday. The first file that we receive is a deals file. This captures all the primary economic terms of all the required and permitted transactions. Next file is a messages file. This is all the bids, offers, cancellations, modifies. This is really the nuts and bolts of the audit trail. And in order for us to do trade practice surveillance, we need to capture those elements so that we can recreate that audit trail and replay that daily market activity. We get connection activity. If a trader has been logged, this is how we're going to do our rule enforcement program. If a trader has been logged on for more than 24 hours, we take note of that. There might be other traders using one trader ID. We're going to look into that. We also get a daily activity file. This is actually the open, high, low, close of the markets. So that'll show the impact of a deal. If there was a large transaction, we want to know if it moved the market 5% versus 50%. So this next slide, this is static data. This just really tells us who is accessing the system and in what capacity. Next, we have our relationship files. Some traders are only allowed to trade certain products. We want to know what those are. We want to know a firm's relationship with its clearing FCM, so we'll know whether they're clearing CME, ICE, or LCH. The really important part of this slide is probably these bottom 2 bullets. 37.9 provides the methods of execution on a CEF. As David mentioned, that's the order book and the RFQs. 37.9A3 is that RFQ requirement to 3 participants, 2 initially, and those should not be affiliates of or controlled by the requester or each other. So for example, if we see a request for quote go out to JP Morgan London and JP Morgan New York, not to pick on anybody, but those are affiliated firms, and that's where the request for quote only went out to, we would look into that. So the next files we receive, the product files. These files are probably the really big learning curve for NFA. As I mentioned, we were out in New York several months learning how these markets traded and the complexity of the products. As you know, there's a much larger universe of tradable instruments in the swaps world than there is in the futures world. So what we did, in order to make sense of all this information that we're getting, clearly we needed a taxonomy to effectively analyze and surveil this data. So we created what we call a product matrix, and that's actually just same as the product taxonomy. That's shorthand for how we group these products together. So I think that's more clear on this following slide. So this is the product matrix that NFA developed. So 45.7 requires unique product identifiers for each product, and also those products have to be sufficiently standardized in order to receive a UPI. So in advance of the Commission determining what is an acceptable UPI, we had to make sense of this information. So we decided to go to what was already out there. So we went initially to the DCOs already clearing swaps so that we could see how they defined the structure of their products. So if you look over on the left here, that's these gray boxes. This is what we took from the DCOs already clearing transactions, and this is the basic framework for our product matrix. And here we're not trying to recreate the wheel or anything. We wanted to use what was already out there as in the industry standard. So then we go over across the asset classes, and these blue boxes, this is the current industry taxonomy, and this actually came from the ISDA OTC taxonomies. So again, we don't want to create anything new. We want to use what the industry is already using. So now, while this is effective for Part 43 and Part 45 reporting purposes, this doesn't really get us to where we need to be for trade practice and market surveillance. This required us to drill down further. So what we did, you can see this in the red boxes. We filled in the gaps here, and again, we didn't do anything new. We used FPML representations, red codes, and ISO codes to fill this in. And this gets us down to a UPI level. So the reason this slide is important is because, as David mentioned, the required and permitted transactions, for all the mandated to be cleared trades, the transactions that are going to be met and become required transactions, for the CEFs to meet this data specification, that really hasn't been an issue to date. They've been able to map to this very well. And for the permitted transactions that have not been mandated to be cleared but are already clearing, this really isn't an issue either. But where we've had issues and the CEFs have had to spend some time mapping to us is for these permitted transactions. They're the bespoke, the not cleared transactions, and I'm sure we'll hear from the CEFs later on how that's going for them. So as I mentioned, this gets us down to a UPI level. But in order for NFA to do surveillance, we actually need to get down to what's called a tradable instrument level. That's the order book level. So as you can see by this slide, many tradable instruments will fit under a similar UPI. And what we're doing, each one of these tradable instruments actually has its own order book. So the 5-year, the 2-year, and I think I didn't mention the spread transactions, the strategies earlier. But if a 5-year and a 2-year actually trades as a strategy rather than an individual leg to that spread, that's going to have its own order book as well. And that's what we need to map to. As an easy analogy that really brought this home for me was, if you think of an UPI contract as like a corn contract in the futures markets, that's not actually what we're surveilling. What we're surveilling is the September 2013 corn contract and the December 2013 contract. And if any of those would trade as a spread transaction and have its own order book, that's how we're drilling down. So that's an overview of where we are today, and of course we'll enhance our surveillance systems as the markets evolve and we gain more experience in these areas.
Thank you very much. Now we're going to go to the market participants. We're going to start with Scott. We'll work down Michael, Paul, and Tom.
Yeah, Commissioner O'Malley, thank you again for the invitation to attend today's TAC meeting. My name is Scott Fitzpatrick, Executive Director in Strategy and Business Development at the Tradition Group. Tradition is one of the 5 founding members of the...
Hey, Scott, can you pull the microphone closer,
Okay.
please?
Usually I'm told I'm talking too loud. So I'm Scott Fitzpatrick, from the Executive Director of Strategy and Business Development at the Tradition Group. Tradition is one of the 5 founding members of the Wholesale Market Brokers Association. We are operational in over 28 countries, covering products in all of the main asset classes: rates, credit, FX, equities, and of course energy and commodities. Each of the WMBA member firms has applied, as David suggested earlier, for temporary registration as a CEF, and we hope to receive approval prior to the October 2nd CEF compliance date. Each of our firms will operate order books, request for quote systems, and other platforms to foster liquidity and provide markets for our customers. We operate, to quote Dodd-Frank and to David earlier, through any means of interstate commerce, using a wide array of modes of communication and execution as required by the unique characteristics of each product. For the last few years, the industry has focused its preparations in what we currently refer to as required transactions, namely those trades in products that have been identified by the Commission as mandated for clearing, and those that we expect to have identified for made available to trade, and as such subject to the execution mandates for swap market participants. These are also the products in which we typically see the most volume, trade, and most frequency. When the final rule came out, we were surprised to see for the first time in a footnote to the preamble that the Commission now expected to implement the CEF regime for all permitted transactions in a timeline of October 2nd compliance date, which in effect gave us 3 to 4 months to implement an infrastructure for many products when our focus had been on a few products over the previous couple of years. As a result of footnote 88, as it's affectionately called, this has raised some serious concerns for the industry. Despite best efforts, we are less than 3 weeks from the CEF rules compliance date, and there remains a lot of work left to do with our customers, testing new infrastructure, for example, for SDRs, with clearinghouses, and of course, with the NFA. I think it's fair to say that WMBA member firms are ready for CEF trading of the aforementioned required transactions on October the 2nd. 3 Wednesdays from now, our platforms will allow trading through any means of interstate commerce in compliance with the CEF rules. We will all have fully functional order books, audit trails, trade reconstruction capabilities, and be reporting those swaps to registered SDRs. The sole concern is the uniform implementation of the vast array of permitted transactions and having all of them ready to go live in such a short period of time. The reason footnote 88's impact is so acute for WMBA members firms, and not necessarily all CEFs, is the breadth and depth of products offered and facilitated through our platforms for customers, whereas other CEFs, as is common in the industry, will offer a much smaller subset of products and maybe even only those deemed for required transactions. Many CEFs do not act as a source of liquidity for those swaps that trade infrequently or have unique characteristics. The product set that will fall within permitted transactions in footnote 88 simply does not have the liquidity characteristics to trade on a screen through the posting of actionable bids and offers. They require more finesse and rely frequently on an intermediary to negotiate terms between counterparties on an anonymous basis. This distinctive role is carried out globally by firms like Tradition. Today, I'd like to raise 3 primary concerns. First, we heard earlier on the data reporting panel of some of the issues around SDR reporting. So I mentioned this is a concern voiced by others, and add that currently pre-CEF dealers and market participants are reporting data to the SDRs and CFTC pursuant to parts 43 and 45. The CFTC is using that timely and accurate and complete set of information for efficient surveillance and enforcement purposes. There is concern that the transition to a CEF reporting regime, as contemplated by the CFTC's rule, will not go smoothly for permitted transactions on October 2nd. In a nutshell, CEFs must continue to build out the necessary technology, populate it with each possible permutation of all illiquid swaps, test and ensure connectivity to SDRs and other market services from and to all systems internally. And at the same time, swap dealers or current reporting parties have to be sure they stop reporting at exactly the same time to avoid the risk of duplicative reporting. Absent careful consideration among all market participants, the Commission risks receiving duplicative reports, incomplete reports, and as such, arguably a suboptimal data set, one that will be of lesser quality than they are receiving today. I think it would be prudent and helpful to all of the CFTC, whom we have been and continue to work closely with and have been very accommodating in trying to understand the issues, or to bring the new regime to the marketplace in such a way that does not disrupt the scope and quality of data it has come to enjoy. Second, while our members are working closely with the NFA, we have similar concerns that necessary systems across all asset classes will not be in place for the NFA to receive, catalogue and analyse the volume and breadth of information on all permitted transactions to appropriately monitor trading activity. An important piece of which is static data generated during client onboarding, which I shall touch on in a moment. We have been in close touch with our colleagues at the NFA, and Jane and Ed have been very accommodating, who have been very helpful, working way more hours than any person should probably need to with our data reporting teams, and will continue to make sure that we transition as smooth as possible for these products. However, with 20 days to go, I can conservatively say that more time would be helpful to make sure everything is done right, providing a risk-free transition into the new regime. Finally, as I mentioned a moment ago, I wanted to raise the issue of onboarding of clients. As of October 2nd, as David mentioned, our current systems and platforms will be obsolete, and our customers will begin trading at Tradition through our then temporary registered CEF. Under the CEF rule, a platform must be registered. However, we risk that some, a few, but realistically not all of our customers will have signed the necessary legal documentation, agreeing to rule books, accepting a new legal entity as an authorised trading venue, and having provided all of the information we require for our own regulatory obligations. This problem is compounded when you consider the number of customers and CEFs. There simply aren't enough lawyers, even in Washington, D.C., compliance staff and technologists for system testing to get it done in less than 3 weeks. As an example, some of our current customers may not even begin to consider our onboarding packets until we have provisionally or temporary registration from the CFTC. And from a business perspective, I don't disagree with the decision on how to allocate limited time resources, particularly when they are not compelled or obligated to use CEFs until a made available to trade determination has been made, which could, as David mentioned earlier, be at minimum a few months away. That's all I have to say. Thank you very much, and I look forward to questions later.
Thank you very much. Michael?
Thank you, Commissioners. I do have some visuals. I don't know how to get them up there. Sorry. No, that's you. Here we go. Apologies. Okay, I apologize. Okay. So I'm here, my name is Michael Yeri and I work for Barclays Capital. I'm here representing the FIA, and we want to get into a few of our concerns regarding CEF implementation. So we have concerns about the impending October start dates. What we're most concerned with being the FCM, which is at the center, I think, of the ecosystem, and being asked to provide assurances and guarantees, if you will, and using that word, it tends to put the hair up on bankers' necks. It's not one taken lightly, and it's a big responsibility. But there's a major difference, listening to all the different market participants, between being technically ready and being operationally ready. Various aspects of the derivative ecosystem are ready, technically speaking, but there has not been a single front to back, soup to nuts, rigorous testing regime carried out on this entire system. FCMs provide clearing services and are comfortable providing a guarantee that trades will clear after execution if capacity exists. But we continue to read through CEF rules and understand what the CEFs and the CFTC thinks the FCM is guaranteeing by providing clearing services on a CEF platform. So this is what we're being asked to provide is analogous to the payment card industry. If you think of the CEFs as merchants, FCMs as issuing banks, clients, and card holders, the clients are card holders. There's a transaction network made up of middleware, limit hubs, CEFs, CCPs, FCM pipes and plumbings, and so on and so forth. And most importantly, there's an electronic verification system. A transaction starts with an authentication or authorization. credit or clearing certainty is extended and funds guaranteed once the transaction is authorized via electronic credit check. Credit is reserved until clearing and settlement or return to the cardholder. Disputes occur. It's important. And chargebacks happen. We're not sure if that's allowed in the new world. They tend to get passed back to the merchant, who is incentivized to ensure that they are doing everything they can to mitigate the risk. While limit checks are required by Rule 173, we do not believe functionality exists to allow the FCMs to simultaneously guarantee activity of a customer across multiple platforms. So, to use the credit card analogy further, think of shopping on the internet. Speed is introduced. Multiple family members might be shopping all at once against the same credit line. We believe that credit hubs may eventually provide the functionality, but we are not there yet, and true end-to-end testing has not been completed. We understand that the CFTC staff believes that because limit checks are required, no trades will break. Therefore, that there should not be any concern on the part of the FCM providing complete guarantees. In the absence of credit hubs, we do not agree that this is true. It's important to note that FCMs are supportive of CEF trading. It's a major market structure change that requires intensive reworking of existing processes and flows and testing to ensure the least disruption to market functioning as possible. Most of the risk resides with the FCM, apparently. It is accountable to its shareholders, customers, CEFs, CCPs, regulators, and the broader market. As such, we have to get this right and are well on our way. But it's unreasonable to ask this community to guarantee what it can't control. So this is a diagram of the pre-CEF, post-mandatory clearing world. Clients do trades, they are alleged and matched and flow down to, via the CCP, to the clearing broker, who then checks to ensure that that line exists. If we actually move to the right, this is the post-CEF world. One more note on the left side. The market's functioning well. We had some panic as we moved into Rule 174, but again, the market absorbed it and has dealt with it well. And I can speak for Barclays specifically, but I do believe I speak for the industry. All trades that have been rejected and resubmitted have cleared. So again, the market functions well. Moving on to the post-CEF world. You introduce CEFs. You introduce potential anonymity. And you introduce multiple trading venues, trading fungible products. This is acceptable, and I'll go back to the market being technically ready, but not operationally ready. Everything works if there's one CEF and every client wants to trade on one CEF. I don't believe it's my job to choose who that CEF is. If there's only one CEF and I take all of that limit and stick it at that CEF, I'm comfortable delegating my limit checking responsibility to that CEF. The problem is that this is what the real world looks like. On the left, you can see what we're entering into once products are made available to trade in a world without a limit hub. CEF trading, by definition, is DMA. The major difference between CEF trading and CEF trading of cleared products is product fungibility. So if you think about a Eurodollar futures contract, I can place a limit at the exchange and be comfortable that it can't be trading anywhere else and it's controlled in that venue. But again, you can see the complexity introduced by CEFs. Two major factors introduce race risk. Race risk is a condition or hazard. It's a behavior of an electronic or software system where the output is dependent upon the sequence or timing of other uncontrollable events. I can't control where the client is trading unless I can control it. A limit hub will allow me to control everything except for voice trading. I don't think we'll ever get there, but voice trading is slow. It's deliberate. What I'm concerned with is electronic trading. I'm concerned with mistakes being made and being forced to guarantee those trades. This is a comparison of the CEF rulebooks that was drawn up by the FIA. These are double-side pages, so it's quite significant. And there's a big section at the beginning on limited liability. So this isn't about me saying anyone in particular is supposed to be liable, but it's me saying for the FCM community that we shouldn't solely bear the burden of any mistakes happening in the system. If you actually get into these, there's no liability or very limited liability. I think in most instances, this is public information. The liability can be capped at $5,000 in a day, $100,000 in a year. That doesn't cover very much. We're not trading peanuts here. This is a significant marketplace trading large flows. All we're saying is that risk should be borne by those who have the information. The FCM community, once we move to the right and we have a limit hub and we have connectivity to all the CEFs, and we can reduce the race risk to only voice trading, that we're willing to accept more risk. We're willing to accept the risk because we go back to the credit card analogy. Every single order that will be placed onto a CEF will have reserved credit or clearing capacity against it. Therefore, removing the need for that back-end credit check. Until we get there, we're basically saying we want to have the ability to ensure that clearing capacity exists post-trade. The Limit Hub does several other things as well. It translates various FCM and CEF limit language and structures. IM, notional, DV01, CSO1. It has a heartbeat to ensure connectivity. Provides a central view for clients of clearing capacity across multiple FCMs. And it vastly limits race risk across screen products by centrally managing capacity across multiple trading venues by reserving limit upon order entry. I think I'm out of time. There's another summary slide here. But this is very important to the FCM community going forward, and I just wanted to make that point. It is solvable, though. Serious work and investment is being put towards this problem, and progress is being made. It's not a blueprint. Foundations have been laid. First, the house has been framed, and we're working very closely together to work towards a solution.
Thank you very much, Michael. Paul.
Thank you, Commissioner. So I guess we also looked at some of the issues, and the pre-trade limit check was one of them, so I won't reiterate many of those points, but we will cover a couple of others. What we did think was important around any discussion of CEFs was continued focus on what we think are bigger picture issues, as well as just those for October the 2nd. We clearly see October the 2nd as the first step in many as we roll out what is going to be a very complicated and multi-step market structure change. Clearly in the big picture, we remain very focused on ensuring that CEFs maintain compliance with the core principles, particularly around impartial access, as we continue to think that's a fundamental component of how CEFs are built out. We appreciate the efforts the CFT staff are undertaking to ensure that the CEF rulebooks, including those submitted for temporary registration, are consistent with the final rules, and certainly welcome Mr. Wagner's comments today around how that's being addressed, because we certainly feel as we get through to any kind of public comment period as it relates to MAT determinations, if there were meaningful inconsistencies in some of those rule books, that would come to the surface in a way that would be complicated around how those determinations were made. For October the 2nd, we think there's definitely real issues that exist, primarily related to onboarding and operational workflow. We think there's some case to recognize the distinction between different markets, and we would certainly highlight that we think the onboarding issues are particularly acute for FX. Overall, I think we believe that considering any action around this is really important that the CFTC consider that a competitive market for our customers is pretty critical. The feedback we have from most of our customers continues to be a desire to see a very competitive, innovative market where they can access a range of liquidity pools and get the benefit of innovation and creativity. On the onboarding side, I think it's clearly an issue. perhaps less so for dealers, considering we're somewhat more used to this kind of way of doing things. But certainly for clients, or end clients, for the first time for them, I think considering direct participation in a regulated venue and the things associated with that, such as disclosures, inspections by the CEF, liability rules, disciplinary rules, and trading protocols, and how they implement that and through policies and procedures internally and how they monitor it and track it, is clearly something that is starting to become more greatly understood by our end clients. I think partly in relation to that, we would link that back to the impartial access standard as being critical. I think it's essential that customers have the option, as was laid out in Rule 37.202, to access CEFs in a variety of different ways, including indirectly. And I think that would alleviate, I think the ability to do that would certainly alleviate some of the issues we're seeing right now with customers as it relates to onboarding. I think it's certainly clear, and I think Michael showed the rulebook comparison chart. I think it's certainly clear from our discussion that many of our customers have neither the appetite nor the resource to connect directly to 20 CEFs and do the kind of complex legal and operational and compliance reviews required to do so. On the workflow pieces, I think we would highlight, well, I won't say any more about the pre-trade check other than the robust implementation of a pre-trade check is fundamental to the market working. I think the clearing workflow, the direct to clearing workflow is clearly a challenge, certainly in terms of getting that implemented in time. And if I look at where our firm is and others and the CEFs, that's certainly one area where we're struggling to get there on time in every case. I think bunched orders is a big issue for many of our accounts. And I think the fact that there is no real central clearing solution and what we call kind of standby clearing, fully ready and available for customers now, that there's definitely some challenges that our bigger customers are going to face who would typically trade bunched orders and then allocate post-trade. And I think that clearly is something that needs to be addressed. And then I think our last key issue is reporting. I think Scott mentioned that. I think ISDA have submitted a no action letter on that. And again, if there were an area of targeted relief, we think that's one which would be crucial. I think we would note when we consider the impact, in conclusion, that we think the dealer-to-dealer market can probably operate okay. I think there's clearly latency in getting rule books out and having access to those platforms, but I'm confident we could get through some of that stuff. We certainly anticipate that there would be some impact to the dealer-to-client market on screens, but that, and I think we would certainly note an important distinction between FX and rates and credit. I think for rates and credit, we certainly observe the existence of other methods of execution, voice, or across platforms not subject to the CEF registration requirement, which could facilitate that trade workflow. But we'd be careful to note that for FX, I think that would be a huge problem, seeking to push clients to revert back to any kind of voice trading. And I think in conclusion, since I'm out of time, I think we think targeted relief, specifically in the areas of reporting and bunched orders, is crucial for October the 2nd, and special consideration for FX, whilst bearing in mind the commercial reality of many of the new entrants and CEF platforms out there and the need for them to get operational as soon as possible if we're to have a vibrant and innovative and competitive landscape for CEFs. That's the end of my remarks. Thanks.
Thank you, Paul. Tom?
I'd like to thank the Commission on behalf of State Street for letting us be represented here. For my sins, I'm saddled with the responsibility for SwapX, our CEF. State Street remains very supportive of the CFTC's objectives and all the work that's been done, and the timelines that have been finally issued have really served to focus the market and move the market from theory to actual practice. So that's been a great result. And we understand the magnitude and complexity for all the participants and the regulators, the challenges of sifting through what's wheat and what's chaff, and really being able to hone in and focus on the things that are important to operationalize the regulatory regime. I'm representing our cumulative experience in designing, developing, operating e-trading platforms across multiple asset classes. And SwapX looks at life through two prisms, which include both foreign exchange and interest rate swaps. So, as I go through my remarks, there's kind of two undertones that I want to kind of throw out there. Whenever you're subject to a mandated timeline, inevitably, not every participant is, poised and ready in the right sequencing. Technologies aren't there, and they may not be able to promptly comply with the letter or the spirit of the regulations. So as such, everybody's always going to look for promoting some form of stopgap solution, solving today's problem and the near-term problem, and that's just practical. We have to do that. However, as a market, we need to be careful that these compensatory and bridge gap solutions don't embed flaws that become kind of part of the foundation, that as we build on top of the foundation will crack and crumble afterwards. Sometimes the loudest voice in the room isn't giving you necessarily the right answer. I'm going to address the practical challenges from a technology perspective associated with the compliance state, and provide some illumination on our experience with the task of onboarding. So the first thing is, as everybody knows, the October 2nd date from a CEF's perspective means one of two things. You either are a registered CEF or DCM, or you cease and desist, period. So there, and there you have that exemption for the single dealer platforms where they can continue to operate until made available for trading determination. So the rigid timeline has been great in serving the purpose of focusing the industry on the practical realities, to enable people to continue trading. So that's one good result. Whenever you do such a kind of a big blunt instrument swipe, there's also unintended consequences. So when you look at the implementation obligations for my colleagues here, it's daunting. And inevitably, they have limited resources, so they're just going to have to practically prioritize what they do. So logically speaking, they're going to have to prioritize, what's looming, what's going to be a required transaction, what's going to be made available for trading. So even if best will in the world, you wanted to get everything sorted out, some things will have to take a back seat. From our perspective, one of our kind of incumbent areas of operation is in foreign exchange. In the absence of having the resources to adapt to the statutory workflows, just even simple things like capturing USI codes, reporting party designations and the like, existing mature e-trading activities will inevitably, they have no choice. They're going to have to shift back to old school voice or migrate to the exempted single dealer platforms. And you're going to have this kind of market asymmetry where you have an existing, robust, liquid electronic trading environment, which now will have to for practical limitations, devolve and revert back to kind of old school techniques. That will also be exacerbated by the extraterritorial questions. U.S., non-U.S. persons, there's a huge lobby from even existing customers of ours saying, hey, we're not ready. Can you just do something outside of the U.S. and cut the market in bits and do the non-U.S. stuff out here so we can keep on trading? and catch up later. So that's kind of one point. The second point is just kind of my experience in supporting the onboarding processes, and we're poised and ready to go. But I wanted to dispel the notion of a sign up and trade kind of process. There is a lot of technology-driven workflows that must precede CEF trading. Because of the resource consumption for each CEF implementation, CEFs themselves will be prioritized or sequenced in how they're adopted. We need to be careful that we don't inadvertently pick winners based on how they're being provisionally registered. And I'll be honest, I see my Bloomberg colleagues, I'm really jealous of those guys because they've had 2 months, 3 months head start, and everywhere you go say, oh, I'll get to you, but I'm working on that Bloomberg stuff because they're the only CEF. So just throw that out there. But the process is as follows. There's definitely, the first process is legal. I'm not going to comment that here because this is a technology panel, but you got to get through these guys' legal reviews, and they're not going to take it trivially. We've received 6 pages of minute comments from dealers about our participant agreement and rulebooks. So they're taking it very seriously, and that's the first process. The second is the establishment of credit relationships. So the credit relationships, we as a CEF, we have the full capability to receive and enforce on a pre-trade basis those credit limits. Now, we need to be careful, and I know that the deal hubs and the central credit hubs are definitely a focus today, and we're supportive of that focus because it's practically impossible to wave a magic wand and have my colleagues be ready to support dynamically every CEF directly. However, we also need to be careful too that we don't embed flaws or flawed models that perhaps will not withstand the test of time, where you have electronic trading meeting electronic trading and have protocols of credit verification where by the time the answer of approved for credit comes, the market's moved and there is no trade. So we need to be careful about that. Just to practically illuminate the tasks that individuals have to undertake, you have to connect to a CEF for order routing. That means for the buy side, you have order management systems that you need to connect. A lot of buy side people say, I'm not going to let my trader just trade. He's got to go through the order management checking process. Sell side folks have to connect their pricing models, and that's, they have to interpret our instrument models and they have to connect their pricing models to that. That takes some effort. On a post-trade basis, straight through processing, for audit trail purposes, capturing your USI, recons, and reporting party designations. You have to get that right. And then from an operational perspective, people have to also map their instruments such that it corresponds to the instruments as we've defined them on our CEF. So there's a tangible technological process that people have to go through. So that's going to impact how CEFs are adopted, the sequence in which they're adopted, how quickly they're adopted, and inevitably it will disrupt trading patterns. So that constitutes my comments. Thank you.
Thank you very much. While you all think about your questions for any of the panelists, Ananda, you're welcome to take a seat up here. I think everybody knows Ananda Radhakrishnan, the director of, what do we call your division anymore? Clearing and
risk.
Clearing and risk. And I can obviously answer and defend his straight through clearing provisions and probably shed a little light on them. I don't know if you want to make a comment, Ananda, beforehand, but I'm going to make a couple of observations. It is interesting to me that, we're not debating whether it's right to have CEFs. Everybody wants CEFs. Everybody wants them to be successful. Everybody wants the pre-trade transparency and price discovery that comes with CEFs. The timetable is a theme that has come up here quite a bit, and the aggressiveness of the timetable and a variety of the issues. And Michael's slide right here leaves it up. And we have some legitimate technology questions that were raised today. Things like reporting was raised in the first panel. DTCC brought it up. Marisol brought it up. The quality of the data being reported in the shift from swap dealer to the CEF. Michael's points about the credit checks and the certainty of clearing, obviously a technology solution. Michael said it's not if it will happen, it's when it happens and how it happens and the process in which it happens, probably compounded by an October 2nd deadline. We heard onboarding issues, whether it's a delay in our ability to approve rule books or offer temporary registration, in which people can say, oh yes, now I get it. I think it was interesting to see the comparison of the rule books, Michael, you had there. And I assume that's a summary. That's actually not the rule books, right? Or a overview? Okay, small font. And then there's the international gotcha. The international rules provided, some review of the international rules by March, which I think was what Mr. Barnier signed up for. And now we have an October 2nd sign up, which I think, Tom, you touched on the fact that forces a lot of clients and a lot of U.S. persons all over the world to figure out whether they're going to be trading on CEFs or MTEFs or OTEFs. And I think that was surprising to many of us that requirement moved, that there is a registration distinction versus a execution distinction that we're going to work with Europe on. So these are the issues that I've been hearing, not only from this panel, but conversations kind of anything since post-August, when kind of people came back and really focused on these issues and really started sharing with the commission. So Ananda, why don't we, there's a lot of discussion before you got here, none of it a surprise to you, so why don't you go ahead and make a couple of comments about what your expectations are and your needs are.
The Division of Clearing and Risk and Division of Market Oversight sent a communication to all temporarily registered CEFs and CEF applicants. CEF applicants about the importance of certainty of clearing. And I want to try and explain what we meant by that. Certainty of clearing of CEF executed transactions, staff believes, is essential, because it also results in certainty, what I would call certainty of execution, knowing that your execution actually took place. Because if your execution is not clear, then what good is your execution? So now the question is, how do you get there? And I'm going to ask you guys a couple of questions. I'm going to first suggest the state where you should get to, and I'm going to find out whether you're going to get there by October 2nd, and if not, why not, right? The state that CEF should get to is whatever is executed has to be cleared. No exceptions for credit. I understand sometimes somebody can make a fat finger error or some kind of operational error, and I can understand why you may have to bust a trade if it was an error. But if it's not an error, whatever is executed has to be cleared. And I'm thinking especially in the context of required transactions, because then if this doesn't happen, why did the Commission go to the trouble of saying that certain transactions have to be required? I understand also the importance of doing credit checks. We have regulation in our books called 1.73, which obliges FCMs, clearing FCMs, to have pre-execution credit controls and engage in credit checks. And just in case anybody is under the impression that you don't have to use automated means to do credit checks for an RFQ system on a CEF, let me tell you the division disagrees with that. You have to use automated systems, okay? Now, the other question is, you have a credit check before execution of the CEF, and then there's been a suggestion that there should be another credit check at the clearinghouse to see whether the trade is going to be accepted or rejected. I want to know why. Why cannot the industry come to a state where you engage in all of these checks before an order is executed in the first place? whoever wants to respond is free to respond.
I completely agree with you that it can, with the exception of a major change to voice trading, which would mean that a voice trade would need to reserve some clearing capacity before. So let's set that aside. I think that's a trade, that's a condition I think we're willing to accept as an industry. But with regard to providing clearing certainty across many venues, it's just simply a case of technology. It's not a case of unsolvable technology or unsolvable market structure. It's just that there are 17 CEFs and 2 solutions have been identified, 2 vendors, and people are building to them. So it's a matter of timing. So the reason you need the back-end check is to shrink your race risk. If there's clearing capacity on it, it'll be clear. If a client has clearing capacity, the trade will clear. But I don't know what that client's doing. Only the client knows what the client is doing. So I can tell them what their capacity is, but at this point, if they want to trade on 17 CEFs, which is a stretch, but more than 1 or 2, somebody would need to ration that credit. What the Limit Hub provides is the ability for the client to trade wherever he wants, he or she, wherever they want. And it's self-rationing. They put an order into CEF 1, credit capacity is reserved, a token, if you will, a heartbeat will exist between the FCM and the CCP. So I can't use that as an excuse for the trade not clearing because there's a live wire in there to the CCP. Barclays good, client's good, client's good. I'm happy to provide a guarantee in that instance. The technology's not there. We will get there. It's being built.
Saparna?
I actually don't know who I'm addressing this to, but as it regards to certainty of clearing, Ananda, what we've been told from the CEFs, we do not have certainty of clearing as clients because if we were to execute against a counterparty that's self-clearing, so if it's any of any of the dealers or like a self-clearing buy-side client, there is no check for credit limits at the CEFs. So that's why, almost all the CEFs we've spoken to have said that you do not have certainty of clearing at time of execution. So to some extent, we've gone through this effort for the last 18 months on coming up with solutions. It seems to have been focused only on the buy side. And the reality is that, if we're going to have some sort of systemic issue, it's not going to be a buy side that's going to cause it. So that's, a big concern for us that you have the October 2nd date, and after all this work and effort, we still will not have certainty of clearing if we execute with many of the counterparties on the street.
Why will there not be execution? Is it because you'll probably go through a credit check, the self-clearer does not,
Yes.
and then the trade won't be cleared?
Yeah, if the CCP rejects it after you've executed it, then essentially we hold the risk of the trade or the break, whichever way we look at it. And the explanation given to us is that the CCPs have not made available a checking mechanism, whether it's in the form of a ping or anything, to the CEFs. I mean, this explanation has come from the CEFs.
Yeah, hey, Nana, I want to say thanks. Genuinely, there's a good deal of confusion around this issue, so I appreciate you being here today and listening. Let me just speak for a moment from the perspective of the clearinghouse, because I think when you asked the question, it was both. It could be either directed to the FCM or the
Everybody, yeah.
or the clearer, right? Yeah. So a trade can happen on a CEF, and theoretically it could be rejected by the FCM, or when the FCM passes along to the CCP, it could be rejected by the CCP. I think your industrial logic is irrefutable. That is, as we move from fewer transactions, higher notional to more transactions, lower notional, automated trading, we want as few hurdles as possible. And so a world where I execute on a CEF and I know it's cleared, that's where we want to get to. It's very similar to the futures model, although in the futures model there are some caveats. Clearinghouses can reject trades in certain instances, but it is very much in line with your vision. The issue we have is that's not what the rules requires. And so we want to get there. But for instance, and I don't have the rules committed to memory as you do, but in one of the 39 rules. It says very clearly a clearinghouse can accept or reject a trade as long as it does it as soon as technologically practicable.
Correct, it does.
And so that's the way we built the first instance of the CEF and the CEF workflow, with the idea, hey, let's start there, let's go live, and let's evolve to this place of complete clearing certainty. If the rules of the game are you need to get to clearing certainty at the risk of sounding cavalier, it's not a big deal. It's just going to take more time, because that's not what we've prepared.
So from a perspective of the CEFs, the technological capability is there. We have the ability to enforce the limit that the FCM gives to any of its customers. And how that gets to us, if it goes through a centralized mechanism that delivers it to us, or if it's given directly, it's a matter of preference from the FCM. I think the missing piece is, how does the clearinghouse expose its credit limits and credit availability with that clearing layer? So we run a marketplace on Spot FX where this exact model lives and operates correctly. A central counterparty exposes its limits to each prime broker, who in turn exposes its limits to every customer, and that's mathematically adjudicated on a pre-trade basis. So therefore, nothing matches that's beyond the credit limits, and therefore everybody knows that's a good trade. Lacking that exposure, and again, you can't wave the magic wand and just wish it to be there on day one, but lacking that exposure, you're always going to have this gulf to bridge. I wanted to respond also to my colleagues, to Michael, the credit methodologies, and I understand the central distribution needs for credit. It's a practical consideration. It's impossible for you to do that today with everybody. But we also have to be careful not to marry ourselves to a process that will not withstand the test of time. And when you look at circumstances where you're pre-consuming allotted credits and creating egg timers and tokens that follow every order, that's simply what happens in the case of a market maker? What happens in the case of someone who's trying to protect orders that they have by putting a lot of stop orders in? If each one of them consumes available credit, they're not going to be able to trade at some point. So, we're happy, and I think most CEFs are happy to receive those credit limits dynamically and adjust to them. But to kind of marry the market to a single token-driven solution may not be the right answer for the long run.
I guess from our perspective, there's really two, just kind of more broadly to start with, I think fundamentally there's two things at issue here. One is really ultimately a debate about liability. And there's, the regulation goes to some extent to basically say, and Ananda, you said it earlier on, that whatever is executed, it has to be cleared, right? And so the problem is that because the venue of execution is different to the venue of clearing, and you can further kind of compound the issue by inserting middleware discussions into the middle of that, to the extent that the CEF is on the hook for being responsible for that, and the CCP is on the hook for being responsible for that, you have this kind of confusion which reigns today, right? And I'm very receptive to the points that the FCM community is making, because at the end of the day, to the same degree that as a CEF, I'll make the argument that, I don't have control over credit because I can only see what's being done on my CEF. The FCM is going to make the argument that they have to understand what's going on in the broader universe and across different CEFs to understand what the credit line actually is. And I think that you have this kind of, you have this debate going on at the moment, which is actually driving fundamentally a lot of these discussions. The reality is that today, we're in a model where, the buy side comes onto the CEF, and the CEF is dependent on kind of information going back and forth, and we don't know that the trade's cleared until we hear from the CCP that the trade's cleared. And so, just to touch on the middleware debate a little bit, the issue with the middleware is that to the extent that the CEF is responsible for kind of that process in the eyes of the client and in the eyes of the CFTC, not from a credit perspective, then clearly from our perspective, we want to make sure that to the extent that we are using any middleware, which we philosophically don't have a problem with, that middleware doesn't expose us to any issues in that chain. Every time you add another component in this daisy chain, you introduce risk into the system. So I think it's, the reality is that, the way the system is designed right now, which is not the ping model, and maybe we'll get there. But I think a lot of pieces have to fall in place for that to actually happen. I think in the short run, we're in a world which is actually quite inefficient, and I think that one of the concerns you have is, I'm curious to see what's going to happen on October 2nd, and I'll also admit that the second part of kind of I think what people are talking about is there is an incredible structural amount of processing which is going on at the moment. I mean, you have a whole community that all of a sudden is being assailed by 17 different CEFs and FCMs and CCPs with all of this documentation they've got to process and try and get through. And I think that I think that's what human nature is such, especially in this environment, that now that we're 3 weeks away, everybody's starting to focus on it. But I think that everybody's kind of here raising the concerns around that because this is a very complex business with a lot of moving parts. So I think they're all very, very valid points.
I put up a slide we did over a year ago. We talked about this issue, kind of the 1.73 discussion. What is the right answer? What do you prefer out of this that would be optimal? Or is it something not on this page that you're expecting in order to achieve your objective?
I don't think I've seen this before, Scott, but I think the model should be, even before the order goes to the platform for execution, that first of all, the FCM does the check against the customer, which you have to do right now. So the order goes, and once it's executed, it goes to the CCP. Now, I'm not saying CCP shouldn't do their own risk management. Please don't get me wrong. You've got to do your own risk management. We expect you to. The question is how you do it. Right? Potentially, you could do it up front as well. And what I'm saying, I guess, is that's the best way to do it. To address Suparna's point, right? Because I think I don't want to speak for Suparna, but it's awful that she doesn't know whether she's going to have a transaction or not, right? Or she doesn't know at the time that she did a transaction, she doesn't know whether it's actually going to be a live transaction. So I guess what I'm saying is the best scenario would be everything's done up front, sort of like the futures model. And for those of you who are accusing me of trying to grab...
Is that actually the futures model? Brian, can I
forgive me, but I'm just a little confused, Ananda, on that particular point, because to have that credit check done up front, how is the CEF going to have a picture of what an FCM's post-trade exposure is to a DCO? Wouldn't the DCO be the one that has that full picture of the exposures of that FCM into them?
Correct. So I guess what I'm suggesting is that before, and you guys tell me whether this cannot be done, although I would be kind of suspicious if you say you cannot. Why, well, let me ask the question. Why can't the check be done, the FCM check and the DCO check be done before the order even hits the central limit order book or the RFQ system?
Suparna?
Yeah, I think that the credit hub will solve for the pre-check of limits by the FCM, for the client or whomever they're servicing. It's for the check between the clearinghouse and the FCM that is missing right now. So, I mean, if there's time for the hubs to actually finish this last leg of work, we'll get to it for anyone who's using an FCM and is willing to use the hub.
Scott, I think your top left, that would be the model. If the CCP communicates the limits to the CEF for the clearing member, right? Because that's the key, right? The key is if, like, Mike could be offering clearing across, say, 15 CEFs, right? So the CCP will need to know what his exposure is, across those 15 CEFs.
I think what's missing there is my credit availability to the client. So if you put the hub, and two things have to check. that I have capacity with the CCP and that my client has capacity with me. Those two things, boom, and it's not slow. So I'm very happy for you to take this risk as a CEF, if you'd like, but I don't think you're willing to. That's our purpose. We just need to be able to check it to provide the guarantee.
Michael, you're saying that FCMB and needs to go, there needs to be some additional lines between the FCM and the client.
Yes, the hub should take lines in from the CCP. So they should be saying FCMA is good. And then the hub should also take in that FCMA is good with this client. Now, those two pieces of information are sitting there. So we can get into whether that's a push or a ping. Ultimately, you want the fastest solution, which would be a push, and then the push could sit so it doesn't slow down trading and so on and so forth. But it needs to take two pieces of information. Now, as important is as it goes up through the food chain, transactions matched, it needs to communicate back to the hub to say you took 100,000 in 01 and that was reserved when the trade went up, just like a credit card, right? When you put gas in your car, it reserves $75, whether you put gas in or not. Okay, it needs to come back in and say, yeah, gas went in, or no trade return that credit or that capacity. This is where the CCP leg comes in, because the trade drops into the CCP. That they can say, yes, that trade has cleared. Every party has fulfilled their obligation, trade cleared, boom, communication back into the hub that says, okay, there's only 900,000 left as opposed to 1 million. And we're back to business.
Yeah, I just have a basic question here. So we were talking to council the other day about the onboarding process and all the documentation that goes with it. And our council mentioned to us that, just curious, if there is a break, how is the industry, how are the CEFs dealing with it in the interim? I was told by council that the worst case scenario is that we might have to negotiate thousands of break agreements. I mean, they're playing it out a little bit. But is that true? And if so, I mean, that's a pretty significant barrier to entry for a guy like me who's a small, hedge fund in this, who's just trying to, put some trades on. So I just some point of clarification, because I've heard that rumor numerous times over the course of the last couple of weeks that there's a potential for some serious backlog of agreements potentially in negotiation.
Well, Michael, when you were explaining the relationships between clients A and B and the FCM, what kind of documentation, to Marshall's point, does all of this require in order to achieve all of these objectives?
You have an FCM. But once we get to the solution, you have an agreement with your FCM. You would then choose a limit hub. I would argue you don't have to choose one, because honestly, all the ecosystem cares about is that an FCM actually is providing clearing capacity and that the CCP has line to that FCM. So you don't have to choose a limit hub, but you might want to engage with one because you want to get extra services or view your picture across your FCMs. But the engagement with the hub itself, and I'm not going to speak, the CEFs can answer their own questions with regard to what kind of documentation is necessary, will just be a mapping exercise.
But I get that. But in the interim, if there's a breaks, and I think historically, I mean, this might be a bit of a red herring because I don't know how many breaks there truly been in the futures markets per se, but I've been told by counsel that this could lead to a staggering number of negotiations across the CEFs for these, quote, break agreements, which is very akin to the argument I made, or the issue I raised last time, which was just trying to put the execution agreements in place for purposes of clearing for a smaller guy like myself was a pretty significant barrier to entry. So I just want to get a sense of whether this is true, that there's potentially this significant potential for my having to negotiate a significant number of breakage agreements. And if so, how are we going to deal with that?
On Monday, the FIA hosted a CEF showcase, and the CEF showcase, the moderators tended to focus on what happens if a trade fails to clear. So where does the FCM obligation lie? So there essentially were two camps. So there was one camp that said, if the trade is delivered to the DCO and they DK it, there's a camp that says, okay, there was never a trade, no trade, because it can't revert to a bilateral obligation if it's a required transaction. There's another camp that said, no, we're going to have a nexus of underlying bilateral agreements to which we will fall back on in order to adjudicate that. And that's the second camp. So, I think your question is really, is relating to that second camp where you would potentially be obligated to have a nexus of agreements.
When does that all come to reality, though? I mean, October 2nd, like, am I going to have this all sorted by October 2nd? Am I going to have to figure out who's in the first camp, who's in the second camp? I mean, it's a big issue for me because I have very limited resources.
Anand or David, you want to answer that?
I think the answer has to be trade never existed, because it cannot go back to a bilateral trade. Right? If it's something that has to be cleared and it is not.
It wouldn't be a contingent, would it?
No. I think, I just off the top of my head, so just so I got the facts right, execution on a CEF, it goes through the FCM filter, right? So FCM says fine, boom. Goes to the clearinghouse. It doesn't go past the clearinghouse filter because the clearing member's gone above a limit, or in Sperna's case, she's opposite a clearing member who is not an FCM, and for some reason that clearing member. So I think the trade has, I think, and don't hold me to this, I need to consult with David, but I think the rules of the CEF will have to say trade never took place.
Right. I think that's right. I mean, obviously, if it's in either case, it's going to have to occur on the CEF anyway, right? So you got to clear. You've either failed the clearing mandate, but even if you failed the clearing mandate, the transaction ultimately, because it's being done through a many mechanism, it can't be done away from the CEF either. So it's going to be on the CEF. So I think the alternative is in that case it fails.
Ben?
So I just wanted to, because there's two things here in the CEF, right? There's an RFQ and the order book, and I think they're different because the RFQ is disclosed, and so in an RFQ mode, you can actually have a waterfall where, if the trade gets decayed, you can fall back on the bilateral relationship of the two parties, assuming it exists, and our view on that is that it should, so that you have that guarantee ultimately. In the order book mode, you don't have that because by definition it's anonymous, and that's where I think there's a lot of confusion because there really isn't anything to fall back on, and that's kind of what this debate is about, I think.
Well, then by definition, if the trade involves a product that the Commission has said has to be cleared, it cannot remain as a bilateral trade. Right? You're breaking the law.
But if it gets decayed from clearing, then our view on that today is that you can fall back. If the parties want to fall back on the bilateral agreement, then they should have that ability.
No, I'm saying you cannot do that. By law, you cannot do that. By law, you cannot engage in a transaction that you have to clear, which is not clear for whatever reason. It cannot remain as a bilateral transaction.
I think, Ananda, the bilateral agreement of what happens if the trade doesn't clear. So it would be, because you can't fall back on a bilateral swap, it would fall into breakage. And depending on who was responsible for the cause of it not clearing, that party would be responsible for breakage. I don't think Ben meant a bilateral swap. It was a bilateral agreement of breakage, which is, I think, what Marshall's point is, like, do I need to have
So that's
several?
what happens now, right? Now, pre-CEF, you had the mandate kick in, right? So what you're saying is you've got these breakage agreements in case something doesn't clear.
Yes, it's in the execution agreements themselves. But I think one thing that the CEF brings to the table for us is that we can execute beyond, the 10 counterparties we're normally allowed to face. So this piece, and it's somewhat linked to certainty of clearing, because your final state, if we apply the pre-check and there should be almost no instance of a breakage, it works. The problem right now is that there isn't certainty of clearing given the infrastructure that we have in place.
So what I don't know is what we think, staff thinks about a situation where it's, if I understand your question, it's not an RFQ. Let's assume that it's a required transaction, right? It's done on an RFQ as opposed to a club. It doesn't clear because the clearinghouse says, sorry, I'm not clearing this. Question is, instead of it being declared void ab initio, does it go into some kind of a breakage arrangement? My initial answer is no, but I'll have to talk to David.
I mean, because ultimately you're talking about, you're positing a scenario where there's an order book and an RFQ. So you're positing a swap that's subject to the trade execution mandate, right?
That's correct, yeah.
And the trade execution mandate, I mean, fundamentally has to be executed on a CEF, and it has to be executed in those limited, those or DCM, and it has to be, when executed on a CEF, it has to be executed through those, limited methodologies. It's either being done through the order book, or it's being done through the RFQ. And if there's a failure, I don't think you can fall back on a bilateral. I mean,
right, because
honestly,
it has to clear as well, right?
Right.
Required transactions have to be cleared as well. So
Ananda, like right now, there could potentially be a couple of minutes, 5-10 minutes between when you think you executed it or the CEF said that it was executed, and then you get a message back saying, for some reason, the trade hasn't cleared. The market moves in that time. So, for like anyone, it's not only buy side, it's also the dealer side to just sit there and not know if they have market risk or not for that period of time. It's going to basically impact, the efficiency of the market, the way it trades. If there is breakage, and I'm not saying they should, because we should reduce the ability for any breakage to happen, at least if you have a position or not. You may not like the fact that the position has to be broken or it goes to breakage, but at least you know that the risk is on or if it's not.
what you're asking, if I understand you correctly, is even assuming the CEF rule says if it doesn't clear, the trade never took place, void ab initio, whatever term we use, it makes it very clear that can we contemplate a situation where the two parties somehow get into a negotiation about one party compensating the other because this didn't clear? Is that what you're asking?
It's for RFQ, and it's only till we get the state of certainty of clearing where both sides are pre-checked and the market feels comfortable that this is working efficiently.
You have to have some process in place to manage an event where clearing doesn't occur. I mean, the two parties to the trade are bearing market risk, and between the time that the trade was struck and the message comes back that it didn't clear, there is potentially an economic impact around that. So I actually misspoke earlier on. I wasn't really talking about there being a bilateral trade on. It's really a breakage agreement and having some mechanism in place that allows resolution of that.
I think the way we handle it is if for whatever reason something doesn't actually clear, the bilateral agreement basically says you cancel the trade or you resubmit. So it's one or the other. So it's ultimately, it's not a bilateral trade that's put on. I think as Ben was saying in Superna, it either gets canceled and it's void or it goes back in.
Is there anything other than liability that tends to be covered in these breakage agreements? I mean, you made the point that the market will move, okay, but the agreement should deal with that, right?
Yeah, I mean, there is, you have a breakage waterfall and, determination of what the price would be. But other than liability for a required transaction, you don't have anything.
Commissioner, there's another agreement behind that one, which is the clearing agreement. And all things point to that agreement, and the main reason a trade wouldn't clear would ultimately come down to the FCM rejecting that trade. And then it's just a food fight over whose FCM has to pay for the breakage. So hence the reason that we are so interested in getting to the ideal state, which is where we can technologically, practicably provide clearing certainty. So it really comes down. So Tom, I'm sure it's true. If I chose for a client, or if the client chose to take their entire limit and stick it at his CEF, happy days. They can do that. Most clients don't want to do that. They don't want to only be limited to a single CEF, or utilize that some capacity, and then intraday it's impracticable again for FCMs to have an army of people on the phone with 200 clients saying, hey, I just used up that limit at CEF A. Can you move some of it over to CEF B? And moving it might be sending another spreadsheet over or logging into a Bloomberg terminal or over, again, 17 different ways. That's translated by the limit hub. It gives us a red button to reject all trades or to reject a certain client trades on all CEFs. We're just not there yet. And today, it's still post-trade. Technologically practicable is post-trade. But we're nearing a point, and again, whether it's October 2nd or in January at some point, where it seems the definition of technologically practicable may exist for one individual CEF, but from the FCM's perspective, which is one to many, it's not there yet.
Ananda, can I? This is the email you sent, which kind of created this issue, and I'm kind of wondering if it's not available by October 2nd, and whether we have 2 CEFs or 5 CEFs or 15 CEFs, and you say, in the second paragraph, it's one way you can, in which this can be achieved, is for CEFs to use pre-execution credit checks. I guess, what are we going to do if they technologically can't meet that objective, or B, if one way they try doesn't meet your regulatory kind of view? And since this is an email and not part of a rule, where do we stand on all of this come October 2nd?
So there are a couple of choices. I mean, I don't think I'm hearing anybody dispute the fact that clearing certainty is important, right? Nobody's disputing the fact. Okay. So the question is, you got this date, and I guess the policy question is whether the commission feels comfortable allowing people to start business as CEFs, knowing that there may be no clearing certainty. Fair question, right? Because we could say nobody can start business as a CEF until you sort this out. I can imagine the noise that we will get, in response to that. But I'm just thinking in the range of possibilities, that is one possibility, and some might argue the most responsible possibility. Like, why are you letting people transact business in what might be required transactions if you cannot achieve the objective, right? But I'm not saying this is going to happen.
Okay, but just, I think the one nuance here is that you have a market that is operating today.
Right.
And that market is going to go through a migration on the 2nd of October.
Right.
I think if you were to say, if the CEFs can't guarantee certainty of clearing of October 2nd, then you can't be a CEF.
Right.
Then I think that the whole electronic trading market, I won't speak for Lee, probably comes to a standstill, because I don't think the issue is with the CEF.
Right.
I think that the FCM community have a very valid issue, which is around this concept of a credit hub and how do they manage credit. And
Right.
so, I think, there's a market that works today. I wouldn't lose, and that market is efficient, and we talked about it earlier on. There's no problem that exists today for October 2nd.
So that's the comeback, right? Like, why are you interfering with the operation of a market that's, of some use? A response could be, well, guess what? Life has changed. If you don't change with it, tough. But okay, so that's one response. The other response is we give people time to come into compliance with what I would call the desired state, right? And in order to do that, I think I need information from market participants as to when they can get there and whether that period of time is something that, the commission can live with.
I don't have any idea whether the time frame lines up, but potentially you could let a CEF begin operating on the 3rd of October and get to the so-called desired state by the time the required transactions are subject to the MAP
That's a great point, yeah. That's
which is
a great
another
point.
3-4 months.
That's a great point. That we could do that because I believe, correct me if I'm wrong, that on the 3rd of October, there will be no such thing as a required transaction.
Right, there'll be no such thing as a required, right, everything's going to be permitted on transactions on October 3rd. I mean, I would point out, though, that the wording of the statement is that must be cleared or that are voluntarily cleared. So in certain ways, that doesn't have anything to do with the trade execution mandate.
That's
It
right.
has everything
That's
to do
right.
with the
I just
clearing
stuck it in
mandate.
there because,
So,
it's
yeah,
clear. But the other thing is, and I'm not going to anticipate Superna, is we also have to keep in mind that this doesn't just involve required transactions, i.e. the trade execution requirement. It also involves the clearing requirement.
Yeah, that's a great point, because all of these are required to be cleared. David said anybody who's trading on a multilateral trading facility has no choice but to trade on a CEF, so we're right back where we started.
Ananda, the other piece that I'd just like to bring up is the rule books that every buy-side firm has to go through in order to either agree to sign up to their market participation agreement or not. We've had very, very little time, and there is not one rule book that has come through to my desk that hasn't come out with at least 10 issues that we need to look at. So, we have a lot of concern that, the choice on October 2nd is either, we are going to be taking on, knowingly take on some legal risk that we don't feel comfortable with, or we're going to have to go backwards in time and revert back to voice trading, which is really not like, the outcome that any of us want.
2 points. One is, if it seems to me, listening to this discussion, if the objective of the commission is to have a repeat of what happened in energy, which is everybody stops OTC and goes over to futures, you're doing excellent work. If you have commission staff as qualified and knowledgeable as anyone in the world, sort of debating here, it's fun to listen to. But I think you as commissioners have an obligation to exercise in loco parentis. At some point, you can't expect, the chairman proudly reported the hundreds of trillions of dollars of outstanding positions. This is a big deal, and let's face it, the stress of breakage, as Ananda knows very well from futures, it is not uncorrelated to periods in markets where you most need risk management. If you get my point, this is going to break when it's going to really hurt. As Superna says, if the markets are locked and aren't moving anywhere, well, you can hang out for a while to figure out what's going on. If markets are really moving, which is not inconceivable given the rates environment that people are looking at, right? Or what we could see in foreign exchange, or have seen in foreign exchange, where you have where you see a couple percentage point move, and thinking about how that translates then into the amount of money that Tom or Brian have to collect in the way of margins, and some of the other things that are being changed in terms of the capital requirements associated with seg funds and so on and so forth. I mean, I think that it is really incumbent on the commission, and I say this as somebody who representing Eris. Hey, great, force it all to futures exchanges. God bless. If you want to preserve an opportunity for RFQ, then it seems to me you've got to have more of your ducks in a row. And I think that the commission, secondly, 2 other points, should really, I think 2 things were observed by a couple of the speakers. One is, you have an obligation under the principles for a level playing field. And to the extent that you're already skewing the way this is going to get rolled out, with some guys being approved earlier, other guys later, the legal guys controlling essentially what's going to actually be able to get papered so you can do. You got to go back and make sure that it's a reasonable jump ball on these things. And secondly, I think you really have an obligation to make sure that practice, as Superna said, you don't go backwards. You don't make it worse than it is now, even for an interim period. Yeah, I was just on the onboarding issue in particular. This is not the first time. This is not the first forum where we've heard the issues around onboarding. I can tell you that the commission, in fact, the requirement of only being able to market participants being able to trade on a CEF only after they've consummated a use agreement is something that very specifically we put into our So we understand the importance. We understand the importance of having market participants on day one when day one happens. So I could tell you we've heard it, decision makers are making decisions, but we've heard the issues around onboarding. Thanks.
There's nothing more on the, oh, Michael, I'm sorry.
Scott, I apologize. Just one last thing. I just want to challenge the contention that was left off that it's the FCM's fault that this is not ready. Again, pointing to the rule book, 17 of these, one of them, they can be ready. I have to deal with 17 different protocols. So the clearing industry does. So I just wanted to politely challenge that contention. Thank you.
Also, some of the middleware is not yet ready to deal with everything that's needed for trading on a CEF and certainty of clearing.
I mean, I just want to be clear. I'm not trying to lay blame on any particular part of the industry. I think this is a very complex problem at a time where, to Cliff's point, the market is, you've got the end of QE tapering and all the rest of it. I think what's happening is that as we get closer to the deadline, a lot of this stress is starting to come out in the system, and I think that it's all of our problems to solve. Certainly, as a CEF, the last thing we want is to be the front end to an architecture that isn't solid or that clients don't feel comfortable trading on, or where FCMs feel that they have undue exposure. So, I think it's a collective issue, and we're certainly willing and want to be at the table to help resolve it in the most efficient manner possible.
Can I just suggest something, Scott? So, for people to think about, which is the FCMs have pre-execution controls, which you're supposed to do right now. And if the CEFs would have a provision in their rule books that said, second thing is the DCOs, pursuant to our rules, have, time to accept or reject as soon as technologically practicable. And I hope that you don't take the full 60 seconds, but assuming that DCOs can do it as quick as possible. But if you would tell the CEFs and the firms that a particular trade execution was not going to be cleared, right, which I assume that you would right now, and if the CEFs would have provisions in their rule books that said, if this happens, the trade never took place. I'm wondering whether that might be a fairly reasonable temporary solution while we get to, what I would call the good state, which is full certainty of clearing.
I think then what you might end up with is that people are gonna just trade with, parties that they know very well and are very comfortable with, which, I thought like one of the reasons we wanted to have CEF trading and clearing was to encourage broader market participation. So you might lose that.
Okay, that's a good point. Because to me, the other alternative, I don't know what the other alternative is. Nobody trades on October 2nd unless you can do this.
Well, you can voice trade.
Speaking of voice trading, footnote 88. David, there's a couple of questions around this. I'm trying to understand. People have said, well, this is a viable competitor to CEFs without mandatory trading requirement. It also changed the way we dealt with international trading platforms. Can you walk us through the thinking of footnote 88 and what its objective is?
Right. Well, just to make, just so we're clear, and also guess I'll summarize it too. The CEF registration requirement is, of course, here tied to essentially whether you're operating a facility for the trading of swaps. As opposed to being tied only to trading of swaps that are subject to the trade execution mandate. The thinking was, and we looked at a number of different things here, 5HA1, which of course is the congressional mandate to us, and to the industry basically says, if you operate a facility for the trading and processing of swaps, you must register. Okay, so what's a facility? We looked around on that. We do know that at least CEFs have a definition, which exists in 1A50, and that essentially is when you operate a many-to-many. It sets forth a many-to-many facility. We combine that with other provisions, again in the CEA, congressional directive, that this provision meaning the CEF provisions in the Act, were to encourage swap tradings on CEF. And accordingly, we put that together and had the view that it was not just, basically it was we wanted to encourage as much as possible to be on CEFs, as we think Congress basically told us when we read the CEA. So that's essentially where we were. I mean, I think that the alternative of tying it to the trade execution mandate, there was a bit of a chicken and egg thing in that case, because the trade execution mandate only comes about once something has been made available to trade on a CEF or a DCM. Query: if there's no requirement necessarily to establish yourself as a CEF or a DCM in the first place, whether that made available for trading basically requirement could basically be evaded fairly easily if people wanted to stay outside and not register as a CEF. So that's in large part where we got to, how we got there.
Thank you. Now, I don't know what kind of conflict. I've heard a lot of concern about it previously. I don't know how big a deal it is, and I'd offer the market participants to really reflect on, leaving single dealer platforms or this one-to-many system outside. How does that affect trading immediately? I'd be interested to hear what people think about that. But one of the ramifications is certainly that any U.S. person thinking about trading overseas now has really been told that they need to be on a CEF or they can't be on anything else. That seems inconsistent with the Barnier-Gensler letter that said that didn't talk about the registration requirement. Didn't seem to reflect this footnote, and it talked about in January we're going to review the trade execution requirements. It never said that anything about the registration requirement, and if anybody wanted to trade on a multilateral, if they were trading on a multilateral trading facility, they'd have to do it here in the United States, subject to the CEF rules. How did that get missed in the letter?
In the path forward statement?
Whatever the Gensler-Barnier letter, whatever that one.
Right. Well, I mean, and again, I mean, the two principles involved cut the letter. The statement itself, one particular paragraph, does talk about the possibility of relief. The relief I would point out, the relief that's discussed there, it is actually not explicitly tied to anything if you read it very closely and parse the words. It is tied, the only thing that's really is kind of clear is it's tied to the trade execution mandate. And in the sense, or the trade execution mandate requirement, in the sense that it's referred to, and there's referred to relief being issued if the trade execution mandate occurs before, I've forgotten the date, March 14th. So the reading on our part is that it's relief from the trade execution mandate. And again, footnote 88 stands for the proposition that the trade execution mandate and CEF registration are distinct concepts. And that's, I mean, that's basically an explanation for the statement.
The CEF rule was done before, footnote 88 was there before we did the letter.
Right, right. Well, I mean, frankly, all the more reason to reinforce that they're two distinct concepts.
Anybody have an opinion on the viability of these one-to-many platforms going forward?
Well, Scott, if I take a point there, I mean, I think the only thing I would say to that is that I thought the objective overall was to encourage trading on CEFs, as David says, but I think the reality of footnote 88, where it brings in more products than anyone I think ever expected day one into the mandate of CEFs, and the amount of work and legwork that has to be done by CEFs to get those platforms ready, that actually there's almost a disincentive to execute on a CEF on October the 2nd.
Just a quick reaction on the previous point on the CFTC European Commission letter. I think beyond the question of interpretation, does it cover registration or only clearing trading mandates? Sorry, I think the important point, the spirit of the letter was that we need to work on a regime that avoid dual supervision of trading venues, on a regime that allows trading venues to comply with one single set of rules. And I think that the conversation I have heard today confirms that this principle is right, because when you see the degree of complexity of the solutions that have to be built to make this work, I think that if you add to that the need to make sure that the solutions you set up here comply with the second set of rules, which may be slightly different, I think this just increases the level of risk. So, in my view, this confirms the need to work on a consistent international implementation of these rules.
From a CEF perspective, I don't know how detrimental a single dealer platform would be vis-a-vis a CEF, but the kind of the asymmetric application of the rules is kind of difficult, right? So if you have permitted transactions that aren't eligible for clearing and will not be so until deep into 2014, then you have a situation where, new patterns of trading, new habits of trading get established at the disadvantage of a CEF. So you are disincentivizing CEF adoption for those types of instruments.
Scott, yeah, a couple of things. One to talk maybe briefly about the cross-border, but also from a personal perspective, maybe probably the best analogy to use as a green card holder here in the US, where I have taxation without representation, would be probably a decent analogy to use in terms of permitted transactions under footnote 88 on CEFs, where we have the taxation of being and operating and having to be a CEF, but we don't necessarily have any representation in terms of the markets having to come to execute on those facilities for anything other than required transactions. The second point, just to address the cross-border, which is just an added layer of complexity to the whole thing, quite frankly, is, I wouldn't even like to guess how many hours are being spent on telephones between not only just the 5 members of the WNBA, but every CEF in this room and every counterparty to swap execution on trying to assess, come October the 2nd, when is a CEF not a CEF in Europe, and the natural development of those conversations when you spend an hour on the phone with people that are represented in the swaps markets internationally is how quickly does this become a bifurcated market, and how quickly do you get to companies like Tradition operating order books in Europe that are delineated through arenas for anyone who's prepared to take the opposite side of a trade from any counterparty, and those people who do not want to see a US person as a counterparty because they don't want to be subject to CEF rules and CFTC regulations. So there's a definite risk of liquidity bifurcation in that respect, unless we can get some recognition of MTFs, for example, as a substituted compliance, which, to my understanding, by the way, is not necessarily that straightforward. I think it was more directed at FBOTs in terms of immediate relief, but MTFs would have to effectively apply. I don't know how you do that, but you would effectively have to apply to the CFTC for recognition of your MTF under the substituted compliance rules.
And I believe we have exactly, how many do we have? We don't have any yet. We have CEFs that have applied. I don't think an MTF that have applied.
And there's, the CEFs that have applied, I don't know that any of them are MTFs rather, as the term is used, the defined term is used in ECs.
Certainly, I mean, some of the other guys here, but I think certainly all of the WNBA members operate MTFs in Europe.
But I mean, our door is open to those MTFs who want to come to us and talk through this provision, but we actually have not been approached by anybody directly who's based in Europe. I mean, we have had discussions with EC representatives around interpreting and implementing this paragraph, but the statement and the path forward statement. But we have not been approached by the foreign platforms yet.
David, the statute provides for an exempt CEF. Can you tell us how we're dealing with that?
Well, as you'll recall, we in the CEF rulemaking that the Commission adopted in May, at that point in time, and the statement was made by the Commission, I guess, I'm sorry, let me backtrack. There is a provision, you're correct, there is a provision in the Act which basically says you can be exempt from CEF registration if you operate as a CEF, but you are regulated by a prudential regulator or a foreign regulator, and your level of regulation is comparable and comprehensive compared to the level of regulation that pertains to CEFs. At that time, the Commission essentially said, we've scanned the landscape and we don't see any regulatory regime out there that's comparable and comprehensive to ours at this point in time. And so we decided not to adopt a set of exempt CEF rules. Comparable, I guess, I don't know if people are familiar with, there's a set of FBOT rules, Part 48, where we actually have a regularized process. So we didn't feel the need to put out a set of regulations. Now, if an individual CEF wanted to approach the Commission, an individual entity who got caught up in this circumstance and wanted to point to their regulator and say, we're comparable and comprehensive to what the CFTC is requiring of CEFs here in the States, I mean, we could take it on board on a case-by-case basis. We have not been so approached.
Yeah, and I just want to put things into context too here. When you talk about the MTF regime in Europe and subsequently will transition into an OTF regime at some point, maybe next year, probably the year after that. There's also a differentiation in how platforms are recognized in Europe between pseudo-electronic platforms and voice broking businesses, which are authorized firms, not MTFs. And that only speaks to Europe. I mean, as a firm, Tradition is represented in 28 countries. We run electronic platforms in most of them. I don't know what the regimes are in Tokyo and Singapore and Hong Kong and Sydney and many other countries around the world, but substituted compliance relief in Europe, where there's an element of sophistication in terms of market knowledge and understanding of infrastructure, and then you go further and further out, and we have endless amounts of calls currently with clients on an international level trying to work out in predominantly the Asian countries as to exactly what regime they're dealing with come October the 2nd, and there's a huge amount of confusion in that respect.
I don't know if there are any questions from Chicago, Chris Haymeyer or Commissioner Chilton.
Hey, Scott, can you hear me?
Yes, we can.
Boy, that's a lot today. And everybody is focusing now on all these issues that's been said before. And there's another one that I'd like to put in here, and that's taking my NFA hat off. We've heard from the NFA, and you've heard where they are in the regulation of these CEFs. And taking my FCM hat off, you've certainly heard a lot from the FCMs today, and lots of issues there. But I'd like to put on my hat from HTG Capital Partners and the Principal Trading Group, because the firms in Chicago have been the market-making firms and have been very supportive of the concept of trying to move bilateral OTC swaps to a cleared, anonymously traded future-style structure, something that I believe and that we believe the public's been expecting as a result of Dodd-Frank, and something the Commission's worked so hard to bring about. And by the way, I agree with Ananda on a lot of his points. He raises some very good points. If those trades get rejected, then the participants will know they've been rejected, and they will know they don't have a trade. Like, it's one of the great things about the electronic world, but that's another whole topic. But Ananda has some very good points there. Based on many different parts of different rules, it looks today that many of the CEFs are going to continue to proliferate a privately negotiated market that's dominated mostly by a few large players. I was interested that Saperna said that she'd like more than just the 10 people that she's used to getting quotes from, and given that the liquidity provision of anonymous electronic traded platforms is that get ultimately cleared are considered swaps, it's safe to say that the new competition in these markets is unlikely to develop despite being a primary goal of Dodd-Frank. This is one of the big goals of Dodd-Frank, is to allow these new market participants to be able to trade in these products. So while the PTGs recognize and fully appreciate the Commission's attempts to allow firms to register as floor traders, which has taken a lot of work on the part of the NFA and the CFTC for exchange liquidity provision, there's a lot of ambiguities and unanswered questions, and so many that I don't know of a single firm in Chicago in the PTG group, I think of which there are 27, not a single one of those firms is going to attempt to use the floor trader registration and begin to compete with the current incumbents in this swap space. And I don't believe that's one of the intentions. I think that the idea is, as Chairman Gensler said in his opening remarks, competition and access will be good for the market. And I'm afraid that we're not seeing any of these firms currently coming in to participate. I have a number of questions. I have 6 of them. I'm not going to read these now because it's late in the day, and I appreciate you letting me chime in here at the end. But I'd like to send these questions in and have them be, I don't know, part of the record or whatever you want to call it. But again, there's so much work here between NFA, the FCMs, the buy-side participants, the CEFs, and of course the Commission. And I just want to make this point that the PTGs are not at the table. They're not participating, and a lot of that is because of the uncertainty. So with all of that, again, I compliment all of the work on the concept release. That was well received here in the Chicago trading community, and we need to promote this video thing in Chicago so we can get more participation at these meetings. Thank you.
Thank you, Chris. And I will make sure, I have your questions right here. They've been sent to me. I will make sure that they are made part of the record, so thank you for that.
Thank you.
I have a question, probably the last question out of me, but made available to trade. The first CEF, now we have 3 CEFs registered, are eligible to make a MAT submission. What is everybody's opinion of that? We haven't seen one yet. When will we see one? How soon will we see one? When does this discussion move forward? Any thoughts on that?
I mean, we're not. I mean, you know, from our perspective, we're waiting till October 2nd to kind of see what we want to push forward. But there's nothing that's driving us to push anything in particular right now.
We're no different. I think, you know, listening to all the issues that need to be resolved, I think it would be a bit dangerous for us to jump ahead, push the execution mandate earlier, given the uncertainty we've been talking about with respect to a whole handful of issues. Once we get a little clarity on that, we're going to be ready to go.
Thoughts before we close the 12th, I think it's the 12th meeting of the TAC.
I mean, I'm just curious. Actually, maybe I have got a passport, so I do have representation. But I'm curious where we go from here. I mean, you've heard today from just about. I don't think there's anybody in this room who's sat here and said, woohoo, October 2nd. Everybody's, for different reasons, got some pretty material concerns about it. We're in an environment where, it's likely that the end of the year is going to be, relatively volatile in the markets. And I'm just curious as to kind of what happens next. Do we, do you have a sense of that? Am I allowed to ask that?
You are allowed to ask that. The good news is Ananda did show some interest in propose to me what were some specific ideas, some concepts?
Just some ideas, because I suspect you wouldn't want us to say all you shut down until you can get to.
It's really not in our interest to do that based on how few people are going to be in compliance with all of our rules based.
So I'm assuming that nobody wants that, right? Okay. So let me ask you this: what do you want?
Great, thank you.
Novel question. I've never asked that question before.
No, but I think what makes sense to me intuitively from an industry perspective is I think what you're hearing from the industry is that we need more time to put certain components in place to make sure this transition happens in an effective way. I don't think there's a problem today. I think that you have clearing in place. I think that part of Dodd-Frank has already been achieved, and I think that. I don't understand why. I understand that the date's the date and there's a process behind that, but I think that, a smooth transition has to be in everybody's interests. And it feels to me that, we as an industry need to get around the table to resolve some of these interoperability issues so that we can do that.
But you accept the fact that you've got to get to a state by a certain point in time. Otherwise, they'll just continue and,
Absolutely, and I think what you have heard is that there's an incredible amount of dialogue amongst all of us here in terms of getting there. I think we're very close, but we kind of need to push it over the finish line so that this happens well.
Scott, I think it's fair to ask also, not just the CEFs, but the FCMs, the clearinghouses, and since Superna's right there, somebody who is not one of them, but who is going to be an integral part of CEF participation. So can I ask what the clearinghouses want? What the FCMs want, and then lastly, what Superna or any other member of the buy side, what they want.
Do you have a pen to write it all down?
You got a court reporter, right? Yeah, court reporter, right.
We filed to be a CEF, and we have a clearinghouse for OTC. But you asked specifically from the clearing perspective.
Yes, well, or CEF perspective.
I'll start with the clearing perspective. From the clearing perspective, we don't have a strong view because, as I mentioned earlier, if all else fails, we reserve the right to reject a trade. And from the clearing perspective, risk management is sacrosanct, and so we have some flexibility. From the CEF perspective, I agree with Ben. There's a lot of unknowns, as Ben I think manifest in the session today. We're prepared to go live on October 2nd, but if the industry had more time, it's not something we would rail against, certainly.
How about a firm, Mike? Oh, yeah. Sorry, Brian. Huh?
Yeah, no, that's okay. I agree with exactly what Tom said. I mean, there was concern early into this discussion about the clearinghouse's ability to maintain its obligations and rights to do that post-trade check, and I think we've clarified and cleared that up. There's a number of issues here that need to get resolved, and we all want to make sure that people have the opportunity to do it right.
Thank you. Somebody said court, and I don't think this is a court, so it's not there. Anyway, if that's been clarified, that I do have the right to reject a transaction, and keeping in mind there are reams of contracts that I have with each and every single client that governs why I can reject a trade. It's not just for the fun of it. There's a good reason behind it. If I preserve that ability until we're technologically ready to actually put that guarantee on up front, and we will get there. This isn't a foot dragging exercise forever. Then I think there are bigger problems just around all the other things we talked about, documentation, onboarding, so on and so forth, than the problems that the FCMs have.
Reject post-execution or like just not take
So if the trade comes through, any one of the 17 CEFs, and there is no limit available as contractually agreed by my client and I, then I can reject the transaction.
even though it went through your filter pre-execution?
Again, until I can close the loops and make sure that that trade isn't happening on 4 CEFs, and we close the loop on it, that's, if you don't have the back end, honestly, there's no point for the front end because of the race condition.
So what you're saying is, if let's say I'm your customer and I place a trade on State Street CEF, right?
Mm-hmm.
And then simultaneously send a trade to the Bloomberg CEF.
Yes.
You're saying that you don't have the ability to cut me off at one place or another.
I can ration their credit.
Yeah, yeah.
So if they have $1 million in 01, I can put, and there are 10 trading rates, I can
Right.
put $100K at each of them.
Right.
Okay, and then just let it go.
Okay.
Okay, fine.
Yeah.
From a manpower perspective, I don't have the people to pick up the phone and say, "Hey, I finished here. Move some of this over there," and
Okay.
it's not practicable.
Okay.
Technically speaking, I believe every single one of them when they say that they can do this. But when you look at it from the one-to-many relationship that I have, and from the client's perspective, on not wanting the FCM to choose and ration their credit, we're not there yet.
Okay.
But if a client has limit to clear, the trade will clear.
The trade will clear.
The trade will clear.
All right. Maybe Superna.
Okay, go ahead, Superna.
So, CEF and any of the trading requirements, they should follow clearing. And in particular, if you look at the NDF market, just because, the nature of them being permitted, we would like to be able to continue to trade on FXall and FX Connect without having to register as a participant on those CEFs. From an infrastructure perspective, we would like to see the limit hub up and functioning, the CCPs being able to handle post-trade allocations, and most importantly, the industry given enough time to test this interoperability, and it's not like the day before that we actually get to do our first trade. And then, if there's still time, we'd like all the CCPs to be able to accept partial allocations because some of them are not there yet. And it's very important from a buy-side perspective. We're not taking market risk on a full block just because like one small allocation may not have been accepted by the FCM.
Two areas that I think were mentioned earlier that didn't get mentioned right here was data reporting. I think, Scott, you brought that up. The continuity of data, it was brought up in our first panel. And I think, Jane, you brought up kind of standards in terms of data. And obviously what we've gone through in terms of our swap data repositories, and the precision that's necessary to make sure that those are functioning well and that we can utilize that data. There's a big issue that I've heard surrounding making sure when the CEFs come on that all the data can flow, and if the data can't flow, who's going to provide it absent, good connections with quality data for all products, right? We haven't phased any of this. And the other one, I think, Scott, you also mentioned was, and I don't think it was one of your main points, but you did talk about some sort of phasing. Banks are ready to go. And similar to the way we adopted clearing, is that something that
Yeah, well, I mean,
Is there, with regard to this onboarding issue that I think a number of people have raised?
Yeah, I mean, onboarding and reporting are two sort of completely different things. I mean, at the moment, there is a reporting mandate in place, and that reporting activity is getting to the SDRs. We have spoken with the commission staff, and I think there's an understanding of kind of sort of an idea of how that could be a phased approach taken to the reporting mandate for CEFs. I think, we've been very upfront, certainly from a WNBA perspective, saying that for the quotes unquote required transactions that we talk about, we are pretty much there and good to go. And because we've been working on that for a while, but when you bring in a lot of the other more esoteric products, then the infrastructure's just not quite there to support that yet. And we've looked at sort of tiering different types of products over time and trying to work with the staff to maybe understand a way that could be potentially phased in. Onboarding, I think we've heard about that from a number of people today. Michael's got his small font, two-sided wad of paper there. I have a rule book which, with its main CEF rule book plus the platform supplements that we have for the multiple sort of platforms that we operate under the CEF, is over 100 pages. And the firms around the table, and Suparna's referenced that, have, it's not a 3-week job to go through 100 plus pages of the 15 CEFs order books that rule books that you want to look at because you may want to consider to have access to that platform. And I think Paul mentioned earlier that different CEFs today operate in different types of markets, and there's a prioritization that goes on in the community. And I think we would be okay onboarding some of our clients, because clearly we're going to focus on those clients because it's the lion's share of our liquidity. But at the end of the day, we service hundreds of customers here in North America alone, never mind the rest of the world, and onboarding all of those clients, signing up to new legal entities, because it's not the IBs that they're dealing with anymore, it's the CEF entity, and the rule book that comes with that is not a small feat at all.
Patrick, I'm glad you spoke to that, and I'm glad that Commissioner O'Malley asked that question, because we were talking about this a little bit over lunch as well. The major success stories, I think, as far as compliance with the new Dodd-Frank rules, it seems to me that there's been some sort of phasing in approach taken to the compliance dates, and so it's not clear to me today, based on what we've heard, what the most appropriate or sensible way to phase compliance in with the trade execution mandate would be. Maybe it's based on market participants, or maybe it's based on some of these different processes related to clearing. I'm not sure, but I think that has to be something we need to explore. If you look at the clearing mandate as being the best example, I think the fact that we took an incremental step there made a real difference. There are other reasons why it went as smoothly as it did, but I think the fact that we sort of focused on market participant categories and built in compliance that way made a lot of sense. And so it just seems to me there's probably some analog we can use in the context of the trading execution mandate as well. So I think we need to solicit more ideas on that and see if we shouldn't change course on these compliance dates for trade execution.
Any final comments or thoughts?
Hey, Scott, one question from my side would be, given the sort of somewhat frothy environment already due to uncertainty October the 2nd, when you say, Mark, that you're thinking about looking at other things and changing course, what sort of time frame are you thinking about that? Because until there is some sense of clarity around that, the message to clients has to be continue to try to head for that October the 2nd deadline. That's a pretty grueling task. So I'm just curious to know, as we leave here today and as we're asked by clients, especially following this important meeting, what we think comes next. I mean, that has to be like a week, I guess, before we would have clarity. Is that a fair question?
It is a fair question. Let me answer. I'm not trying to deflect it, although I sort of am. Ultimately, it's not really up to us. I think the input from the staff and what they learned today is going to be hugely important. The chairman was here this morning, and I think it's fair to say Scott and I are probably going to follow up with the other commissioners about this and follow up with the staff some more. But I guess it's hard for me to give advice, but probably the best thing to do for now is to continue planning for October 2nd, and then we'll continue these conversations after today and see where we end up. But I guess I would ask Ananda and David if they have anything else to add. I mean, I sense that there's an appreciation for some of these challenges on the part of both David and Ananda, but whether or not you guys are prepared to recommend something to the chairman is a different matter.
I think we'll both discuss it. And
I can tell you that this has already been discussed with the chairman. So I mean, this reinforces things that we were.
Has already, you said?
The concerns about onboarding, concerns about data reporting, the concerns about quality of data that would be coming to NFA, they've been in front of us for a number of weeks now, and so I'm confident the chairman is well aware of the concerns. That's what I'll say.
Paul, if I could just say, there's no coincidence in the day we've had this and the time we've had it. You know, could we have had it earlier? I would have liked to, but getting everybody's schedules. You know, this is right in between the initial CEF applications that could have been approved, and where we are today is obviously just 20 days short of when these things go live. I wanted to have a good, robust discussion. We've done that. I think we've raised a bunch of questions around technology, feasibility, workflows, throughput, capacity, et cetera. All good discussion, so I'm very pleased with that. I think we've clarified a lot of points. This whole credit debate was very useful to me. I think there's more to the reporting issues that I did not appreciate earlier, that I have a better appreciation now, and I continue to be reinforced on the capacity of the variety of different steps, all trying to get to the same goal, not necessarily getting the same direction from the commission. So I appreciate the challenges everybody's going, and where I started this was nobody is resisting this. They want to meet the dates, they want to meet the goals, they want to be successful, competitive trading CEFs, and I want to help them achieve that. Can we do it by October 2nd? I think we probably break a lot of eggs to get there, and I don't know that that's a magical date. It's an arbitrary date, in fact. So let's do something that makes sense. Let's think about what we're going and what we will achieve, and we will get there. I'm quite confident of it. So with that,
Thanks.
I appreciate.
I guess I would just say, so for what it's worth, I just think understanding how you're going to trade in a market as big as some of the markets we're talking about is not something you can find out at like 11 p.m. the night before the thing actually works. I think that's a very meaningful concern that everyone will have if there's not information coming out fairly quickly.
Mark and I appreciate that. There's no doubt about that. I greatly appreciate everybody's participation. I thank you for the witnesses, for their efforts and to provide the testimony and the PowerPoints, et cetera. So thank you very much. We'll regroup on the next TAC meeting, but thank you very much for attending today.